Eddie Perkin is with us now, Chief Equity Investment Officer at Eaton Vance. And Eddie, I've got to start with these names here, the GameStops of the world. I'll throw BlackBerry into the mix. It did have some material news. It sold some patents to Huawei, so it's not on nothing that the stock might have increased. But the moves themselves say something about the market. What's your take on all of this activity?
In quantum mechanics, they have a concept of the multiverse, the idea that there are multiple universes. And I think in politics in recent times, we've seen some of that where there's two sets of people on a particular issue that see the world very, very differently and appear to be living in different universes. And I think we're now seeing that in the equity market. Some of the stocks you've mentioned are trading on fumes, trading on day trading activity and message board activity. Meanwhile, other parts of the market, like the reopening trade stocks that you mentioned earlier, are very cheap, certainly relatively cheap, and even in many cases, absolutely cheap. And so they seem to be operating in different universes. And I think it will come to a very bad end on the former group.
So just give me your perspective, because we get to this stage of the market, and those of us who have been watching markets a long time start to recognize, right, that everybody can kind of agree that valuations are stretched, things feel frothy, strategic moves start being made where you think, what's that about really? Is that about fundamental, or is that just about capitalizing on the current environment? And yet, folks like you can't just opine on that and then not do anything. You actually have to give advice about what to do. We're reminded that cash is an asset class. It's just not a very attractive one. So what do you do in a market that feels like this, where there's so many falling knives you want to dance out of their way?
I think cash gets a bad name. The real value of cash is not the interest income you earn on the cash, but it's the option value that comes with it. If you have some cash, some dry powder at your disposal, then when opportunities in the future come your way, you can take advantage of them in a way that someone who is fully invested or leveraged cannot. So I think having some cash during most times is sensible for that reason alone. But you know, it just leave the penny stocks, leave the go-go stocks, leave the story stocks to the side, and focus on the rest of the equity market where there are interesting investment ideas. I think good. If you're interested in staying somewhat defensive, I think there's good relative value in utilities, real estate investment trusts, even consumer staples, which we haven't liked for a long time, mainly because of valuation, are now starting to look fairly attractive on a relative basis. And then there are stocks that are dirt cheap on an absolute basis. I would put energy in that category for sure. Most commodities, I think some of the banks qualify as good absolute value, by which I mean, regardless of the interest rate environment or how other assets are valued, you should get, I think, a decent return if you buy and hold for a long period of time. The compounding nature of dividends and growth will be sufficient to generate a good return. You can't say that about GameStop.
Or even some of the big tech names that got us here. I want to just dwell on those 2 points there, because both energy and financials, and let's be clear, we're talking U.S. financials here, face regulatory headwinds, Biden administration risk, you might say. We don't know what it is. We don't know how the kind of blue sky thinking meets the reality of, you know, running an economy and not wanting to actually kill businesses. How do you come down on that risk when you think about those two sectors?
Well, with respect to energy in particular, and I mean, we can look at the headlines on the Keystone Pipeline from last week. To the extent you restrict supply for climate change reasons, you're starving the industry of capital. That, for an investor, for a company that already has assets, productive assets, that's not a bad thing. It means you've got less competition. Commodity prices, at least in the short to intermediate term, probably go higher. In the long run, there are a lot of challenges that the industry is facing, but you could have a multi-year period where energy stocks produce better returns on capital than they have for a long time. And if nobody else wants to own them, I will, because I'm interested in generating good returns for Eaton Vance shareholders. But on financials, I think it's more, there's a little more uncertainty because you've got they're moving on interest rate expectations, inflation expectations. What's the shape of the yield curve? You do need an improving economy and an improving, steeper yield curve for the banks to continue to work. But they've been out of favor for a long time. And this time around, in this crisis of the last year, the financial sector has not been the source of the problem. They've been very well capitalized, and they've done their part to help facilitate recovery.
Let's just talk then for some of these leaders of this market that make some of us a little nervous on the valuation front, but that still have maybe some runway when it comes to growth. Do you like the big, the big five, if you will, the stocks, the leaders that got the S&P 500 where it is today?
I would put that group, the top five, top six constituents in the S&P 500, which were responsible for nearly 2/3 of the return of the S&P 500 last year, which is a striking statistic. I would put those in a very different camp from the stocks that we were talking about earlier, the BlackBerries, the GameStops, and so on. These are real companies. They generate very significant free cash flow margins, and they continue to grow despite their size. However, they are priced richly. And on that basis alone, not because they're bad companies or there's anything wrong with them, they're just a little too expensive. I think there are better opportunities elsewhere in the market.
We do have this, maybe it should have been expected, Eddie, but the delay in stimulus actually landing in pockets and bank accounts, and that does seem to be rattling markets a little bit. Is it changing anything in your outlook around things like yield and the like? I mean, is it changing kind of what you think in the short term?
It's funny because the COVID environment of the last 10 years, or of the last 10 months rather, has feels like 10 years, has impacted people very differently. Some people are out of work. Some people are at home, able to do their jobs, collecting a stimulus check, not spending as much, playing with their day trading account. And at least from a financial perspective, maybe not from a personal perspective, but from a financial perspective, are better off than they were a year ago. And so there are a lot of debates that we're having amongst our investment teams with particularly how much of the strong consumption spending that we've seen in the last year will be permanent and resilient. I think you can make the case that an e-commerce company is probably taken share permanently, but has a cereal company permanently got people eating more food at home, or is that something that's going to reverse and people go back to eating in restaurants once they're comfortable doing so? So I think those are the debates around consumer spending, and I think the recovery will be very much consumer services led, whether that's airlines, hotels, restaurants, concerts, what have you. It'll be those kinds of activities where you see the resurgence in spending.
Eddie, always great to have you with us. Appreciate your time. Eddie Perkin, Chief Equity Investment Officer at Eaton.